You've probably heard the term dividend, but what does it actually mean? And how does a company even decide to pay one? Let's break it down. So, what is a dividend? Think of it this way. When a company makes a profit, it has a choice. It can reinvest that money back into the business to grow, or it can share a portion of it with its owners. A dividend is simply that a portion of a company's profits that it chooses to share with its shareholders. When you own a share of stock, you own a tiny piece of that company. By paying a dividend, the company is essentially giving you your slice of the profits. Here's a simple example to make it crystal clear. Let's say a company declares a dividend of 50 cents per share. If you own 100 shares of that company's stock, you would receive $50. It's that straightforward. Usually, this money is paid in cash and deposited directly into your brokerage account, ready for you to use or reinvest. Now, how often can you expect to see these payments? Well, it really depends on the company. Many dividend-paying companies have a regular schedule, often distributing dividends quarterly, so that's 4 times a year. However, some companies pay monthly, which is great for generating a steady income stream. Others might only pay once a year or on a semi-annual basis. The key takeaway here is that the payment schedule is entirely up to the company and its policies. This brings up an important question. Why don't all companies pay dividends? If you look at your portfolio, you might notice some of your stocks don't pay them. The main reason is growth. Many businesses, especially newer or fast-growing ones in sectors like technology, choose to reinvest all their profits back into the company. They use that money for research and development, expanding into new markets, or acquiring other companies. The idea is that this reinvestment will lead to a higher stock price in the future, which is another way for investors to profit. So, it's a strategic choice between rewarding shareholders now with dividends or investing for potentially bigger gains later. So who makes this decision? Dividends are not automatic. They aren't guaranteed. A company's board of directors is responsible for deciding if a dividend will be paid and exactly how much it will be. This decision is based on the company's financial health, its cash flow, and its future plans. The board can vote to increase the dividend if the company is doing well, or they can reduce it or even stop it altogether if the company is facing financial challenges. This flexibility is crucial for a company to manage its finances responsibly. For investors, this means that while dividends can be a fantastic source of income, they shouldn't be the only factor you consider. It's important to remember that dividends aren't guaranteed. A company's ability to pay them can change. However, understanding what dividends are, how they work, and why some companies pay them while others don't is a fundamental part of being a knowledgeable investor. It gives you a deeper insight into how companies operate and how they choose to share their success with the people who own a piece of the business, the shareholders. It's just one of the ways you can benefit from owning stock alongside potential appreciation in the stock's price itself. So next time you see that dividend payment pop up in your account, you'll know exactly what it represents: your share of the company's success. Thanks for watching. If you found this explanation helpful, don't forget to like this video and subscribe to our channel for more financial insights. See you in the next one.